Okay, so here we are going to start our discussion about what is financial statement analysis. Now, financial statement analysis to help us to determine financial performance of a company. We analyze the financial statement, being it income statement, balance sheet, statement of retained earning, and the statement of cash flow to determine what kind of performance this company is doing it. It very much possible, for example, Amazon. In the first 10 or 12 years of Amazon life, they always posted net loss in their income statement. However, as we know, Amazon is one of the best companies in the world. So we want to know when the companies are posting information, what kind of information they are posting and what really meant, because it could be is a new company, is an old company, it's a service company, it's a manufacturing company, it's a company that providing us future products, or it's a company that's providing us, products that are dying or people are not interested in buying. So in order to do that analysis, we go from year to year with and compare the performance with a competing company. So for example, Walmart is a retail company. So what other companies that are in the retail, for example, Target. So we can compare the performance of Walmart with retail companies such as Target, or because Walmart has a good grocery business, so we can compare their performance with grocery stores such as Kroger, for example. Okay, so who needs this information? Investors and creditors cannot evaluate a company by examining only 1 year data. So in order to do that, we have to have multi-year data. The rule of thumb is most people like to use at least 2 years period, but 5 years are considered good. So any 3 to 5 year period would be considered good, but 2 is the minimum requirement. The tools can be used by small business to owners to measure the performance by financial analyst to analyze stock investment. It is very difficult to do for a small business owner, because a small business owner can provide you information about their income statement and balance sheet. And since small business information are not publicly available, so Walmart, so there is a website, SEC, Securities and Exchange Commission, we earlier talked about. They have a website called Edgar. Edgar is basically a database. That is a database that gives you information of all the audit reports, financial statements, and annual reports that a company files, say for example, Walmart. So you can find those reports and other related information that by law or by rules, Walmart is required to provide them. So we use various kinds of tools to analyze. So the idea behind financial analysis is to analyze the performance of the company, also to analyze a stock investment. So for example, a financial analyst may analyze a company and find out one thing. Suppose a company share is selling for $100 per share. So the job of a financial analyst to find out, is this $100 a truly a reflection of a company, or it is selling at low or selling at high. So the reason investment company do that, suppose a company is selling for $100 and the financial analyst, after analyzing the last 5 year data, say, oh, this company is selling at a low, so we should buy it because we are expecting that the price of the share will go higher next year or next quarter or next month. Another way of looking at it, somebody might say, hey, this company shares is selling for $100, but our analysis says this share price will go down. So it is high time that if we hold this share right now in our portfolio, we need to sell it. Otherwise, we may suffer some losses. That one thing. Another thing is when you go and ask for a money from a bank, say $1 million loan, the bank would like to see your financial statements and read your audit report and other information they need to figure out whether you are credit worthy. Like, would you be able to pay back that $1 million? Would you be able to digest that $1 million, invest that $1 million in the business and utilize it and give them back? So for example, if you are borrowing $1 million at 5% interest, So that means your business has to make more than 5% return on that $1 million investment in order to pay back the bank. 5% on a monthly, quarterly, or a yearly basis, the interest. So these are the things we need. The financial statement analysis, we do that. So in order to do that, we use certain tools. So the number one tool that we do or we use, and a lot of questions you're going to see in your exam and in your quizzes, is ratio analysis. So we have what we call financial ratios, that we use those financial ratios to analyze the financial statement. So ratio analysis uses balance sheet, income statement, a statement of cash flow to provide us information about these financial statements, whether they are giving us a good indication of their performance or bad indication. Difference in the application of GAAP across companies or within the same companies can affect the reliability of the information, because GAAP application may be a little different in Target for something and a little different for Walmart. So it is, but they are in the same industry, retail, so it should not be a lot of different. But we cannot compare Walmart with ExxonMobil. ExxonMobil is in a different business and Walmart is in a different. So they may use different treatment of GAAP rules in their respective area of business. There are limitations of GAAP. For example, immediate expensing of R&D means whatever research and development, the money that you spend, you expense. Non-recognition of assets that can be reliably measured, and differences in the makeup of the company. For example, type of products or industries can also affect the useful of ratio analysis. So what ratio analysis basically measure? They measure the ability to pay current liability. Is the company able to pay payroll? For example, every company requires to pay at least twice a week. Every 2 weeks, the payroll to their employees. Are they able to pay? Measuring the turnover and cash conversion cycle. So that's what we discussed in financial accounting last semester, that we have the turnover. So that we discuss account receivable turnover, we discuss accounts payable turnover, we discuss inventory turnover. So all of these things tell us what turnover means. Means if you are selling things to your client on credit, how quickly you can collect money. If you are buying things on credit from your vendors, how quickly you pay them cash. Inventory turnover simply means if the inventory that you have, how quickly you sell that inventory and how quickly you collect cash and how quickly you pay. So that gives you the total cash conversion cycle. All right. The next thing is measuring leverage, your ability to pay debts. So some of your liabilities are short term, some of your liabilities are long term. Those long term liabilities also requires you to pay interest on a monthly, quarterly, or a yearly basis. So is your business generating enough cash to pay these liabilities? So that another part is profitability, how profitable you are compared to your competitors. Also, it helps analyze the stock as an investment. Is your company a good investment? Is this company share price are gonna go up in future or gonna go down? That's kind of information that this analysis provides us. Now we're gonna talk about what are the limitations. What a red flag simply means the information that financial statements or the audit report or management analysis or notes to the financial statement that is going to provide us. For example, earnings problem. Earnings problem means the company has difficulty selling their product or services. Decreased cash flow means they have difficulty collecting cash from their customers. For example, their credit policies are too liberal. They are not taking enough precautions when they are giving credit to their customer. Too much debt means the company has debts up to their eyeballs. 80%, 90% of the company has liabilities and only 10% are the assets. That's the problem. That means it's highly leveraged, means somebody can buy your debt and take over your company. Inability to collect receivable, against the same thing, decrease cash flow. The cash flow, the cash comes in the business. So for what you do, you sell your inventory, whether you're selling on cash or credit. If you're selling on cash, fine, your cash is in. If you're selling on credit, how quickly you are able to collect those receivables. Are your customer paying? So for example, we talk about 210 and 30. If we give this to our customer, that if you pay me within 10 days, I will give you a 2% discount. Else, this account receivable is due in, the whole amount is due in 30 days. So if your customers are smart, they will pay you within 10 days. So to get an additional 2% discounts. Buildup of inventories. Sometimes business buys a lot of inventories in expectations that they would be able to sell it, but for one reason or another, those inventories are is still there and they are unable to sell it. And when the inventory stays there in the warehouse, it could be stolen, it could be a breakage, or they could be out of date. So then there is a loss of inventory. That loss could reduce your profitability. Then we are talking about trends of sales, various trends in inventory and receivables. So trends, when we're talking about, is your sale every month, every quarter, every year is increasing or decreasing? How much inventory are you keeping in? How much loss you are taking on inventory? How much receivables you have month to month, quarter to quarter, year to year, and how much receivables you are unable to collect from the customer. So for example, if you are unable to collect 1%, if you are collecting 99%, 99 cents on every dollar, that's very nice. But if you are collecting 90 cents on a dollar, that is weird. So that means you are losing 10% or 10 cents on every dollar. That would decrease your profitability. So that's something that we need to, can indicate something is wrong. Of course, these are the things that are going to tell us what is wrong, but not pinpoint the problem, right? So, and another thing that could create a trouble for a company is legislation. Maybe the company is dealing in a product that product is not conducive for our environment, international affairs. Maybe another country says we are not going to buy this product from US. Scandals. You may have heard a lot of scandals the company in the last few years has faced. That is, scandal cost them their reputation, and some people do not want to buy their product or services or want to be associated with those businesses. So these factors can turn the profit into losses. Should be analyzed over a period of years to consider all relevant. As you know, business go through cycle. In some cycle, business makes money. In some cycle, business lose money. So we want to analyze. That's why we say earlier, 2 years is the minimum, but 3 to 5 years, and I would say 5 years is a very good time to analyze a company to find out how well or how poorly they are doing. Always involves uncertainty is a part of our business. All of us drive an automobile. We all carry auto insurance. We carry the auto insurance not because we face the chance of accident happens or accidents happen to us on a daily basis. No, we are carrying that insurance just in case if accident happens and I get injured or my car get broke down, I should be able to get the money from the insurance company to either fix the car or pay the hospital bill. So uncertainty is a part of any business, like any individual, right? Now we're going to talk about some of the ratios. The debt ratio. It expresses the relationship between total assets and total liabilities. Ratio of 1, like number 1, indicates debt finance all asset, means all the assets that you have, it's based on the borrowed money. Higher ratio means greater pressure on the business to pay interest and principal. As a law, when you are borrow money, you are required to pay the interest as you promise. You may promise them every month, every quarter, or every year you have to pay, and at the maturity date you have to give them back the principal amount that you borrow. So the formula is given here. Debt ratio is total assets divided by total liabilities divided by total asset. The next ratio we're going to talk about is asset turnover ratio. Asset turnover ratio measure the amount of net sales generated by per dollar invested in assets. So in a statement of cash flow, we say that cash flow from investing. Cash flow from investing is usually a negative number, is the cash that you are investing in the asset. And your expectation is that you are going to bring a lot of cash due to this investment. So for example, you invest $50,000 in your bakery business. You open a bakery after investing $50,000. So at the end of the year, you want to know how much cash this bakery, which is an asset for you, has generated. Suppose this bakery has generated $100,000. So that $100,000 suggests that for every dollar that you have invested in the business has produced $2. So your net sales, suppose, is to 100,000, and your average total asset means so you have a beginning assets on January 1st plus the ending assets on December 31st divided by 2. So suppose you didn't buy any asset during the year, you have 50,000 at the beginning of the year, 50,000 at the end of the year. So your average is 100 plus divided by 2 is 50,000, and your net sales is 200,000. So you divide, so that will become 50,000. And then the asset ratio, net sales is, suppose you have $100,000, you divide by average total asset of 50,000, you getting $2. So the 2 reflects for every dollar you invested here, you make $2 out of it. That's a very good ratio. The third ratio we're going to talk about are return on sales. And return on sales basically evaluates your operational efficiency, how well you are running this business. So measures provide insight into how much profit is being produced per dollar of sale. So for example, you make $100,000 in total sales, right? Out of this $100,000, your expense is $60,000. So your income turns out to be $40,000. So what we are saying that every dollar that comes into the sales, 60 cents are going into various kinds of expenses and 40 cents are going as your income. Now that's very good if you make 40 cents for every dollar. Okay, so this is the formula: operating profit divided by net sales. Okay, return on asset or return on a ration. So measures how profitable the company uses assets. So return of assets is return on sales, and asset turnover you can calculate, that will also provide you. Trend analysis. So trend analysis, trend uses the percentages. So it's a form of horizontal analysis. Please remember this, that there may be a question, either the difference between or the similarity between trend analysis and horizontal. It's indicate the direction is business. So for example, every quarter, quarter 1, quarter 2, quarter 3, quarter 4. So for example, first quarter you make $25,000, second quarter you make $30,000, fourth quarter you make third quarter 40,000, and fourth quarter you make 50,000. So you can see that every quarter your sales is increasing. So that's, and at what ratio. So we can make the base year as usually the year 1, or the quarter 1 is always the base year, and it's equal to, and that's how you calculate the formula. Vertical analysis is basically relationship is used for income. So like I said earlier, so you have sales 100,000, so then how much cost of goods sold, how much gross profit, from gross profit you minus your operating, what percentage. So for example, your sales are always 100%, gross profit say is 40%, cost of goods sold is 40%. So you subtract, so you get your gross profit 60%, and your operating expenses suppose is 30%. So your operating income turns out to be 30%, and you pay tax 5%. So your net income is 25%. So that means for every dollar that comes into your business, 40 cents is going to provide that product or service. So suppose you are selling you're a bakery. So every dollar that is coming into your business, 40 cents are going into making that cake. And 30% are going like in utilities, rent, insurance, interest payment, things like that. And 5% are going in towards tax. So 25% after paying everything is going to, so every dollar you're going to make, 25 cents are going in your pocket as your net income. The next thing we're going to talk about is a common size financial statement, the relative importance of various accounts. So that's the same thing that we have talked about earlier in the vertical analysis, the common size financial statements. We're going to talk about in terms of, so by reporting only percentage, it removes the dollar value bias we see when company comparing numbers in absolute terms. Common size statement also an analysis of different firms, especially when they are different in size. It report only percentages and no dollar amount. So that's we can apply for the balance sheet. Then we can have common size income statement and common size balance sheet. So common size income statement, common size balance sheet use a vertical analysis, an income statement which each line item is expressed as a percentage of the value or revenue size. So like I did it earlier, in which I made the income statement and I say sales are 100%, that you weren't going to see in the common size income statement when the sales are always 100% and the rest of all the expenses and including that income will be the part, will be a small part of that sales. Common size balance sheet is a vertical analysis telling you what percentage of assets, liabilities, and equity we have in comparison with other companies. So that ends the discussion for chapter number 1, and I will post this picture as with this video as soon as possible.